Welcome back to the Deep Dive. It is Sunday, February 1st, 2026. Today, we are taking a hard look at a company that occupies a very strange, almost paradoxical space in the global consumer market. It's a brand that everyone knows. Most of you probably have one of their products in a drawer somewhere, but I'm willing to bet very few investors actually understand the massive engine overhaul this company has undergone in the last 5 years. We're talking about Casio Computer Co., Ltd.
It's great to be here. And you're absolutely right. Casio is a fascinating paradox right now. If you just glance at the surface, you see, cheap calculators and digital watches. But if you look at the research stack we've pulled for today, specifically the data from late 2025 and January 2026, you see a legacy hardware engineer fighting for its life to become a digital recurring revenue powerhouse. For our listeners joining us from the Japan Stock podcast feed, or maybe you know the show as Hayu in Chinese or Ayu in Japanese, we usually look for that hidden logic behind the numbers, and Casio has plenty of that.
That's the tension I want to explore today. We have this mental image of Casio as the cheap and cheerful brand, the $20 watch, the high school math tool. But the numbers tell a story of $3,000 titanium luxury items and, I still can't believe this is in the report, emotional robots.
Emotional robots, yes. We'll definitely get to the Mouflin. But that weird mix of products is actually the key to understanding their survival strategy. They're trying to pull off a very specific pivot, moving from selling boxes to selling feelings.
Selling feelings. That sounds a little like marketing fluff.
It sounds like it, but look at the margins. They're moving from functional utility, this watch tells time, to emotional value, to, this watch makes me feel tough or wealthy or nostalgic. Because, frankly, in 2026, nobody needs a watch to tell time.
We have funds for that.
Exactly. If Casio wants to survive, they have to sell something else.
That's a fair point. So the mission for this deep dive is to figure out if this transition is actually working. We see massive growth in North America, plus 34%, but China is dragging the anchor. It's a complex picture.
That's the geographical split, but the internal split engineers versus marketers is just as important.
Let's start with the basics for context. Casio has been around since the 40s. Their corporate creed is creativity and contribution. Usually, corporate slogans are just wall decorations. But with Casio, this actually means something historically, right?
It does. They're historically a 0-to-1 company. They invented the Casio Mini in the 70s, which was the first time normal people could afford a calculator.
Right. Before that, they were the size of a typewriter.
And cost a fortune. Then they invented the GSHOCK in 1983 because an engineer dropped his watch and it broke. He just decided to make a watch that wouldn't break, even if you dropped it from a 3-story building.
Which is the definition of product outthinking.
Precisely. I made this cool thing. I hope you buy it.
And for 40 years, that worked.
But the shift we are seeing in the 2026 strategy documents is a move to market in. That means listening to the user first, then building the product.
Okay, so how does that business break down today? What are the actual pillars keeping the lights on?
You have 4 main buckets. First and foremost is timepieces. This is the GSHOCK, Baby G, and the high-end Oceanus line.
The cash cow.
The absolute cash cow. It funds everything else.
Right.
Second is education or edtech. This is scientific calculators, but more importantly, the software side, which we'll get into. Third is electronic instruments, specifically the Privia piano line. And fourth is system equipment, like handheld scanners for logistics, though that's a shrinking piece of the pie as they restructure.
You mentioned the market in, shift listening to the user. I want to jump back to that emotional robot you teased. Is this a real product that contributes to the bottom line, or is it just a concept car?
Oh, it's very real. It's called the Mouflin. It recently won the Satya Electrics Plus Grand Prix. It looks like a furry guinea pig with no face. And it uses AI to develop an emotional bond with the owner.
A faceless guinea pig.
It sounds odd, but think about the demographic in Japan and, increasingly in the West. Aging populations, lonely urban professionals, it's warm technology. It's designed to be held and petted. It's a perfect example of Casio trying to solve an emotional problem, loneliness, rather than a calculation problem.
That is a huge pivot from tough plastic watch. It shows they're willing to get weird to find new markets.
It is, but it's risky.
Let's look at the roadmap that got us here. They have this midterm strategy called the C30 project, targeting 2030. What's the headline goal there?
The buzzword they are obsessed with is LTV.
Lifetime value.
Exactly. Lifetime value.
Can we define that for the non-finance listeners?
Sure. Old Casio wanted to sell you a watch for $50 and say goodbye. Maybe they see you again in 10 years when it breaks. New Casio wants to sell you a subscription or a collectible or a digital service that keeps you paying a little bit every month or year. They want to maximize the total profit they get from you over your entire life, not just one transaction.
That's the holy grail for hardware companies.
Yeah.
Apple does it with services. Peloton does it with subscriptions. But how does a calculator company do it?
Well, first they had to trim the fat. Between 2020 and 2024, they went through a brutal selection and concentration phase. They killed the compact camera business.
I remember that. I had an Exelum camera back in the day. It was great.
We all did. But the smartphone killed it. Casio was smart enough to exit before it bled them dry. They refocused those resources into timepieces and education. But it wasn't a smooth ride. In late 2023, they hit a massive speed bump. The ClassPad.net incident.
This was the security breach.
Yes. October 2023, unauthorized access to their education server. Personal information was leaked. For a company trying to tell schools, hey, trust us with your students' data instead of just selling you a plastic calculator, this was a nightmare scenario.
It's a total trust violation.
Exactly. And it forced a governance overhaul. They actually separated the role of chairman and president. In Japanese corporate culture, that separation is key for oversight. It was a wake-up call that if you want to be a digital company, your cybersecurity has to be as tough as your GSOC seeks.
So recovering from that and the supply chain mess of the COVID years, where do they stand right now? It's early 2026.
The momentum is divergent. That's the best word.
Yeah.
If you look at the January 2026 data, the world is split in two. The West is booming, and the East, specifically China, is cooling rapidly.
Let's dig into that data. You mentioned North America as the star.
It's incredible. North America posted year-on-year growth of 34%.
34% is tech startup growth, not legacy manufacturing growth. What drove that?
A massive holiday season, Black Friday 2025, was huge for them. But what's interesting is that it wasn't just Amazon sales. Offline channels, retail stores were booming too. It seems GSHU Pay has hit a fashion cycle resurgence in the U.S. The brand is cool again.
In Europe.
Also strong, up 22%. The reports highlight Spain and Italy specifically. It seems the utilitarian chic look is working well in Southern Europe.
Okay, so the West is buying, but then we have the elephant in the room.
China.
China is the struggle. Recent growth is sitting at plus 5%.
5% doesn't sound like a disaster, though.
It's not a disaster, but you have to look at the comps, the comparison to the previous year. That 5% growth is bouncing off a massive drop of minus 47% the year before.
Ouch. So it's a dead cat bounce.
Essentially, the zero COVID hangover and the real estate crisis in China crushed consumer confidence. For a decade, China was the easy mode for growth for Japanese brands. That era is over.
So if the volume is gone in China, what's the strategy? Just give up. No, they pivot to quality over quantity. This is a major theme for Casio globally, but especially in China. They don't mind selling fewer watches in China as long as they're selling expensive ones. They are targeting the super brand days on Tmall and focusing on the 100 million users who track the brand. They want to sell a $1,000 watch to a super fan rather than $20 watches to 50 random people.
That brings us to the macro environment. We are in 2026. The economic landscape has shifted. What are the headwinds?
Exchange rates. If you invest in Japanese exporters, you live and die by the yen. Casio is extremely sensitive. A 1 yen fluctuation against the dollar impacts their annual operating profit by about 1 billion yen.
1 billion yen per 1 yen move. That is incredibly volatile.
It is. And in 2026, we have the Bank of Japan raising rates and the U.S. Fed cutting them. That narrows the interest rate gap, which usually strengthens the yen. The super weak yen that has artificially puffed up their profits for the last 3 years is likely fading.
So the trading goals are coming off. They have to prove they can make money on the actual product, not just the currency arbitrage.
Exactly. And speaking of the U.S., while growth is at 34% now, we have to watch the policy environment. With potential tariff changes or trade friction in 2026, that 34% growth could hit a wall if import duties spike.
Let's get into the deep dive of the products themselves. I want to talk about this metal revolution. You mentioned they are trying to raise unit prices.
This is basic economics. A plastic GSHOC costs maybe $10 to make and sells for $100. A metal MRG costs more to make sure, but it sells for $3,000, maybe $4,000. The margin dollars are exponentially higher.
$4,000 for a digital watch. I've seen these MRG models. They are hand-finished titanium, beautiful engineering, But are people actually buying them?
They are. They're positioning them as alternatives to luxury Swiss watches. If you're a rugged, outdoorsy tech entrepreneur, you don't wear a gold Rolex, you wear a titanium GSHOC. It signals a different kind of status.
Self-wealth.
Exactly. But there is a weirder tier to this strategy. The virtual GSHOC.
I saw this in the notes. This is the metaverse stuff.
Yes. They collaborated with a move-to-earn app called Step.io. They sold NFT sneakers.
Virtual sneaker.
Virtual sneakers. 800 pairs sold out in minutes.
Okay, playing devil's advocate here. Is this just a marketing gimmick? Or is there a business model?
It's an experiment in brand equity. Think about it. A virtual sneaker has zero manufacturing costs.
Zero shipping costs.
Zero inventory cost. It is pure margin. If Casio can convince people that a JPEG of a GS-Check item has value, they unlock a revenue stream that is infinitely scalable.
It's the ultimate LTV play. Monetizing the brand without making a product.
Right. But it relies on the metaverse remaining relevant, which is a gamble in itself.
Let's switch gears to the education business. Use a Japanese term in the pre-show notes. Gakuhan. What does that mean?
Gakuhan stands for academic sales. This is Casio's true moat. In the US, you might buy a calculator because it's on sale at Walmart. In many other countries, you buy a Casio because the school tells you to.
So it's institutional lock-in.
It's deeper than that. Casio sends teams into countries to help write the math curriculum. They train the teachers. They ensure the textbooks feature examples that use Casio key sequences.
That is diabolically smart. If you learn on a Casio, you can't use a Texas Instruments or a Canon because the buttons are different.
Exactly. It's a language. Once you learn Casio, you stay Casio. The ClassWiz scientific calculator is dominant in over 100 countries because of this.
But hardware is dying in the classroom. Kids use iPads.
Which is why they are pushing ClassPad.net. They're trying to move that lock-in to software. They have a feature called ClassPad Scoring that grades homework automatically.
I saw that it won an award from the Ministry of Health, Labor, and Welfare.
Yes, for reducing teacher workload. And that's the stickiness. If you save a teacher 2 hours of grading time every night, they will fight the school board to keep that subscription.
So they are selling time back to the teachers.
Correct. That's the subscription model they are banking on.
Let's touch quickly on instruments. The Privia piano. What's the insight there?
It's design triumph. They realize that pianos are usually ugly black boxes that get shoved in a corner. The Privia PXS7000 is designed to look like mid-century modern furniture.
Mustard yellow was the color I saw.
Harmonious mustard, yes. You put it in the center of the room. It's slim and smart. They open up a market segment for people who care about interior design rather than just people who play piano.
It's lifestyle marketing again. Okay, we've covered the what. Let's talk about the how much. For the investors listening, what is the return policy? Casio is known for hoarding cash.
They are very cash rich.
Yeah.
But their policy is actually quite shareholder friendly. They target a DOE of 5%.
Explain DOE. Why not just use payout ratio?
DOE stands for dividend on equity. If you peg your dividend to your profits, which is payout ratio, your dividend goes up and down with the economy. If Casio has a bad year, your check shrinks. But equity, the book value of the company, is stable. It generally goes up slowly. By pegging the dividend to equity, they are promising a stable, rising floor for dividends.
It tells the investor, we are good for it, regardless of the yen rate.
Exactly. Plus, they target a total return ratio around 60%. And here's the kicker. They have allocated 50 billion yen for investment, 30 billion for growth, 20 billion for strategy.
And if they don't spend it?
They give it back. They have a plus alpha clause. If they can't find a good company to buy or a good technology to invest in, they will do share buybacks.
That shows discipline. I like that. They're going to light money on fire just to say they did M&A.
It's very disciplined capital allocation. They're basically saying, we will grow or we will pay you.
So bringing this all together, we have a company that is successfully rotating its geography winning in the West while managing the decline in China, and rotating its products winning in luxury metal while the cheap plastic market saturates.
That's the summary. It is a textbook example of a legacy firm managing a transition without blowing up the core business.
So looking forward 3 years, what is the one thing you are watching?
The valuation multiple. Right now, Casio trades like a hardware manufacturer, low PE ratio. If they want the stock to double, they need to trade like a software or brand company.
You have to do that.
They need to prove the LTV story. Can they turn a one-time watch buyer into a lifetime subscriber to the Casio ecosystem? That is a much harder engineering challenge than making a watch shockproof.
It really is. And it leaves us with a bit of a provocative thought to end on.
I've been thinking about this virtual GSOCC project. With the NFT sneakers and the metaverse push, Casio is essentially placing a bet that a digital watch doesn't actually need to tell time to be valuable.
That is a wild thought. A watch company where the time telling is optional.
It raises the question, are they right? Is the brand strong enough to exist purely as a digital asset, a status symbol in the cloud? Or is this just a distraction from the core engineering that made them great? If the metaverse hype truly dies, do they have a product there?
That is something to mull over. Is Casio a tech company, a fashion house, or a legacy manufacturer trying to find its way in the dark? The answer is probably all of the above, and that's what makes them such a fascinating watch in 2026.
Absolutely.
That brings us to the end of this deep dive into Casio. Thank you for listening.
Thank you.
Make sure to subscribe for our next deep dive into Japanese equities. We'll see you then.